from Grace & Co Financial Services. We're a whole of market mortgage and protection advisory based in Downend in Bristol. But what I'm going to start with before I go into the kind of nuts and bolts of what I do is a lot of people normally ask me about where my name comes from. So this is where my name comes from. So Grace was actually my maiden name. So this was my dad. I lost my dad about 8 years ago. He was a builder, and he really just ignited my interest in housing and homes and property in general. So the idea was that he was going to retire and we were going to then sort of buy houses and sort of do them up and sell them on. And then he had the gall to go and die. So I'm very angry at him about that, but there we go. So that's where the name comes from. So it's a very cherished part of what I do. So that's where my name comes from. So a lot of people also ask me when we talk about why it is we do what we do. I mean, the practicalities, similarly to Jess, I've got twins. My twins are 15 going on 21. 30, whatever. But the photo on the left is what I think they look like. The photo on the right is actually more what they look like. My 15-year-old son is now 6'1". My daughter is 5'10". So I'm without a shadow of a doubt the smallest person in our family. But this running my business actually gave me the freedom to be able to work whilst they were growing up, because as we know, anybody who is trying to be a parent and work, run a business, whatever it is, it's a lot of plates to spin. So although my business is not where I want it to be right now, it has facilitated me being at every sports day and Christmas play and, you know, school disco and all of those things. So they are the reason that I do what I do. So what do I do, you say? Oh, bear with me. So very simply, there are three kind of main aims to what we do. We help people buy residential property. We help people buy investment property, commonly known as buy-to-lets. And we help people review rates that they have on current mortgages, whether that be residential or buy-to-let. So whether you're a first-time buyer, you're a next-time buyer, so you're trying to move to a bigger house or downsize to a smaller one, whether you've got a mortgage and are going to stay exactly where you are, but your rate is due to change. These are all really good introductions to us, because these are clients that will need help in making their way through the house buying, selling or remortgaging journey. So it says on there we've got 82 mortgage lenders. That's now increased because we've had more private funders coming in. So some of them you will recognise. We've got about 105 different lenders at the moment, whether it be on mortgages or second charge, that's additional lending. Some of the common ones that you will come across, the high street lenders, Nationwide, NatWest, Santander, Barclays, all the kind of standard high quality sort of lenders. We do also work with quite a panel of sort of slightly left of centre. So people like Precise, Accord, Mortgage Trust, Newcastle. So if we've got clients who are particularly old, if they want to do interest only, if they've maybe had some challenges with credit in the past, there are still absolutely lenders that will help in that kind of situation. And what generally happens is when these clients come in front of us and we complete a full fact find, I liken my mortgage brain to one of those, you know, those twisty little index cards that used to get in the 80s that used to kind of flap around. That's how I kind of sort of look at my brain. So as soon as they're talking about what they're looking to do, what they need, and how they need help, I'm automatically sifting in lenders that can and sort of can't help them. So that's what happens, I think, when you've been in the financial services industry for 30 plus years. Anyway, moving on. So what else do we do? So we advise our clients on protection, because if we're going to talk about a mortgage, which is the biggest financial commitment that someone is likely to make, we often then talk about protecting that should the worst happen. And I'm not going to go into some of the terrifying statistics about how likely you are to die before the age of 65, contract a critical illness by the age of 65, be unwell or be in an accident, which would mean you'd be off work. But the statistics are very much there. The companies that we work with, the insurance companies that we work with, work very much off claim statistics. So it's very much happening. And we see clients all the time that live under the bubble of kind of, it won't happen to me. But I think even if we look personally at our own lives, at our own social circles, at our own families, we probably know someone who has suffered in some way, whether it be dying, suffering a critical illness, or being unable to work for any particular reasons. It's a crucial part of really sensible financial planning. And we do all of that in-house. We've got people that can help with that. We also have a bank of kind of trusted advisors that we work with for other things that impact on your finances as well. And a typical thing for that are things like business protection, health insurance, wills, trusts, powers of attorneys. So although Jane isn't here today, we work very closely with the likes of Jane. So as a solicitor, not only do we use her services for conveyancing, so if somebody needs some help when they're purchasing a property, but she can also make sure that there are other legal documents in place to ensure that if anything should happen, everything is documented down about what you want to happen. So whether it's putting properties in trust, whether it's putting a will in place to make sure that your asset goes in a really timely fashion to the people that need it to. I've put health insurance on there because actually, if I've got a single person, no dependents, no children, it might actually be better financial advice for them to have something like private medical insurance, because actually they're still just responsible for themselves. And actually a better solution for them might be if they've had an accident, fallen off a ladder, hurt their back, they can't work, it might be better for them then to have some private medical insurance to be seen quickly, to be fixed, and to be put back to work as quickly as possible, rather than paying out for something like life cover, which won't actually pay out because they haven't died. And, you know, even if they had, they've got no dependents to give it to anyway. So business protection is particularly important if you are a director of a limited company. So things like shareholder protection, key man cover, anything that would remove people from your business that are an integral part of receiving some income from that business, you need to make sure are fully protected. And we work with a raft of financial advisors that would be able to advise on that kind of thing for you. So although we deal with the crux of mortgage and protection, we have got a kind of bank of really specialist people that we can introduce you to for other things as well. Now, I talk about the fact that I would like a really lovely, straightforward referral, and I think I have one, care of Mike, who used to be with us. I know. But just to let you know that we also deal with the slightly more complex. We aren't order takers. We do tend to look at the big sort of scenario to see how we can help clients. And I've touched on this example before, but it's such a good example of how we kind of think outside the box. I think it's worth sort of going over again. So just to let you know, we've got a client who owned a property in his sole name. It was valued at about 650,000. He had a mortgage of just over 202, and it was with Santander, where the fixed rate didn't finish until November of 2023. Now, we started having a conversation with him back in January of 2023. He said, I want to sell my house. I'm going to move to South Wales. I'm going to downsize. I want to be mortgage free. That's what my priority is. So I'm going to pay my mortgage off. I'm going to sell my house and pay it off. And I said, that's absolutely fine. Your penalty will be about 7,000. So what I would recommend that you do is once you've found your new property, we will port your mortgage over, and then you can keep your rate until November. And he was like, yeah, but I want to be mortgage free. And I said, I understand that, but you haven't found a property yet. By the time all the conveyancing has gone through, it's going to be another 3-4 months realistically before that purchase goes through, which is going to take you 3 or 4 months closer to November. And if you then just paid the mortgage payment for the remaining months until November, that would be much less than the £7,000 penalty that you pay to come out of it. So he was like, that's absolutely great advice. That's why we keep you around. That's why we work for you. That's what we'll do. But oh, no, because it's never that straightforward, is it? So what actually happened is he couldn't sell. The interest rates just started to go a little bit interesting. Not everybody in the market is able to afford a property at 650,000. So we had to think outside the box. We swapped his residential mortgage onto a buy-to-let, and he let that property out giving him an income of about £2,100 to £2,200 per month. We increased his mortgage from the 202 up to 278, and that released enough money to put a deposit on his new residential property. We did both on a 5-year fixed rate, so we had stability over both mortgage payments, which made his new monthly interest only payment £1,295. So his onward purchase, he had a nice deposit. Purchase price was agreed at 472,500. New mortgage of 397. Like I said, that was on a 5-year fixed rate to mirror the other one. Everything was tied up nicely, and in 5 years' time, he can then review the whole scenario. And then if at that point in time, he chooses not to be a buy-to-let landlord anymore, the property can be sold, his residential mortgage can be repaid, and it's all job done. But whilst that didn't work out for him, he's getting an income of 2,100, and his mortgage payment is only 1,200. So very quickly, how you can introduce me. Anybody who's talking about a mortgage advice, anybody who's really confused about the state of play, just a friendly little introduction to say, my friend Emma is a mortgage broker. She's whole of market, which means she deals with over 100 different lenders. Let me give you her number and she'll call you and talk you through the options. So anything really where you can take responsibility for me contacting your client is a really good way to do it. Other than that, as a good backup, let me drop you an email with her details. I'll link her in and then you can catch up from there. So any kind of one-liner to people that you've been talking to, saying to them and me, like, so-and-so, this is Emma. She's the one I talked to you about earlier when we talked about mortgages. Can I leave you both to make contact? That's a really good introduction for me. So that's me, Emma from Grace & Co. Thanks.
Thank you, Emma. We do have a minute or two just for some questions. So what questions are there in the room of Emma? I've got one if no one else. All right, I'm going to go first. So in your scenario of your man who went down a very different route.
Yes.
He's now gone on to an interest only
yes
mortgage. So
yes.
Is the idea that then as he sells the other one that he would go on to repayment to kind of cover off that? Because at some point you have to pay.
Yeah.
Right?
Absolutely.
And I think that's one of the things that people are confused about on a repayment.
Exactly. So this is
find the money.
Exactly. So this is where we talk about sort of looking outside of the box. So with a buy-to-let mortgage, so on his existing residential property, they were happy to take on the 202,000 plus the additional 70 odd for a deposit, because that amount of mortgage on an interest only basis was more than satisfied by the 2,100, 2,200 pound rental income that he was getting in. So on buy-to-lets, they tend to ignore what your personal salary is. They look really at the rental income that you're getting from that property to make sure that that interest only mortgage payment can be serviced. So that in isolation is absolutely fine. It's restructured onto a buy-to-let. He releases money for his deposit. It can be done on an interest only, fixed for 5 years. It's all tied up nicely. The second part of the conversation then is he's then got 74 grand or 75 grand deposit to put down on a property at 400 odd. So on that scenario, we picked a lender that would specifically work for interest only, because he wants to keep his payments to a minimum, knowing that in 5 years' time, his property that's now worth 650 might be worth 675, 700, 725. And even by the time that's sold, if you take off the £275,000 mortgage, he's still got enough as a tax-free lump sum then to absolutely go and pay off his existing mortgage. So what a lender will do is look over the two and say, they've got a property worth £1 million, they've got mortgages of 500,000-600,000. That's a really good risk for us, and therefore, because of other contributing factors, really good credit file, good employed on a full-time permanent basis, good basic salary, they were happy to do the both on interest only.
Cool. Thank you very much.
He's a happy boy.
I'm sure he is. Other questions from anyone?
Just a quick one. Do you also deal with at-risk people?
Yes, we do. There's a lot of focus at the moment on vulnerable characteristics. So when we're going through fact finds with people, you talk about people that are classed as mortgage prisoners.
Yeah.
So people who have taken out mortgages and then for whatever reason their personal circumstances have changed, whether it be they have become ill, cannot work, made redundant, whatever it may be. And there is now much more help and support out there, one, to support them with their current circumstances, but two, then if they wish to move, upsize, downsize for whatever reason, there are often extenuating circumstances. So we do absolutely deal with people like that. Yeah.
Thanks.
Fab.
Just a quick one from me, Emma. Do you come across shared ownership? Can you deal with shared ownerships as well?
Absolutely. Shared ownership is received a really bad press sort of up until recent times. So for those of you that haven't come across it, shared ownership is a government-backed scheme where you can get yourself on the property ladder by buying only a proportion of that property, where you then go and then rent the remaining sort of parts. So a typical example of that is if you go and see a property at 200,000, but you don't have the salary or affordability to afford a mortgage to buy a property at 200,000. On a shared ownership basis, you can buy 50% of it, for example. So then your share is only 100,000. Your income only needs to support the 100,000 plus a bit built in for the affordability for the rent. So your deposit can be smaller. The impact of sort of providing evidence of your income is less because you're only sort of doing less of a mortgage. But there's so many things that are built into the shared ownership scheme that benefit these people. So the fact that you have got the legal right to go on and buy further tranches of that property to get you to 100% ownership. There are limits by how much your rent can go up each year, which actually puts you in a more advantageous place than being a private tenant where they can put your rent up to whatever. There's very sort of limited guidelines at the moment with regard to that. The downside of that is that it's a very popular scheme. So when these properties come on the market, Matthew. So when these properties come up on the market, they go very, very quickly. So it's a very good scheme to get you on the property market.